So we are going to take a look at a lump sum study. We're going to look at an individual with a lump sum of money that wants to get it into a high cash value life insurance policy, but they don't like the idea of payment. It's more so, hey, what's the most efficient manner I can get it into a life insurance policy and maximize my cash value? That's the name of the game. That's their main goal. So when we have a cash value life insurance policy, or I should say, let me back up, for this case study, what we're going to look at with a cash value life insurance policy is a 60-year-old male. So we're going to look at someone a little bit older with a lump sum of cash to see how can he optimize the cash value at the end of the day. We're going to assume a lump sum of $300,000. Goal again is to maximize cash value. And the company/policy dividend rate, the gross crediting rate, is about 6% with this particular sample. So the question is, and this often comes up, is, hey, if I have a lump sum of money, say it's $300,000, and the insurance company is paying a dividend rate presently of 6%, maybe it's just the guaranteed rate of 4%, doesn't it make sense for me just to give you all the money up front so the money can begin to compound right away? Does that make sense? Is it possible? Well, the question is, can I do it? That's the question we'll often get. And the answer is yes, but it won't be that attractive. Meaning a one-time payment, if I just take that $300,000 and put it into a policy in one shot, we're going to assume a non-MEC here because we want to keep the tax benefits alive within the life insurance policy. With a non-MEC, it won't be that attractive. So as we look at the mechanics here, main goal is efficiency. How do I get the most juice out of the money that I pay into a policy? I want to optimize the cash value first and foremost. Spreading it out over a number of years with a life insurance policy will actually make more sense. And we're going to break it down and go into detail here. What we're going to look at is an example of taking that $300,000 and funding it over 1, 3, and 5 years. So you'll see $300K, $100K for 3 years, and then $60K for 5 years. Same total of $300,000 at the end of the day. And the goal here is, again, make it as efficient as possible and also a non-MEC. So obviously for a single pay, we could look at a single premium life insurance policy, which would be a MEC. That would look good, but we've got the MEC status and it kind of ruins everything. So what we've got up here is an example of a policy of our 60-year-old male. On the left, we see a policy of with a one-time payment, $300,000. Center, $100,000 for 3 years. Far right, $60K for 5 years. Total of $300K in all of these examples. So 300, 1 times 3, 60 times 5. Okay. Now, what I will note here before we get into the mechanics or start breaking down the columns, let's do it this way. Look at the death benefits. They are a little bit oddball figures, right? You've got 4,280,000, 1,426,000, and then 856,000. So this is a little bit of my OCD coming into play when we design these policies, which I do quite a bit. But what I was aiming for, just for pure apples to apples comparison, same company, same health rating, all that good stuff, were clean MEC limits. So 4.28 million, MEC limit was exactly $300,000. 1.426 million, MEC limit was a clean $100,000, and then 856 MEC limit for the same 60-year-old male was a clean $60,000. So what we're doing in this particular example is funding up to the MEC line, not going over, because we want to keep the tax benefits that cash value life insurance carries. Now, these colors, red, we've got a description here, represents the base premium still due, but the policyholder not paying it. So the policy has to pay for the premium, meaning, let me back up. If the premium's still due and I'm not paying it out of pocket, it has to come from somewhere. The policy can borrow from itself, or if there are enough dividends and interest to cover it, the policy can pay for itself through surrendering a portion of the dividends and interest. So red will represent the policy paying for itself, yellow represents the break-even point, and then light pink represents policy with the strongest cash value over time, meaning which option gives me optimum cash, because that's what we're looking for, efficiency. So let's begin on the left. A one-time payment of $300K. These are all optimized with this insurance company, that 10/90 split, 10% premium, 90% PUA, optimize the upfront cash and long-term, especially on the guarantees via long-term. So, strongest cash compared to the other examples in years 1 and 2, because he got the most money in one shot. 30K base premium, 300K out of pocket. Now, here's the interesting piece. Beginning year 2, he pays nothing in. In red is the $30,000 base premium that's still due, but he's not paying it. So what's happening is the dividends and the guaranteed interest portion is supporting that premium on its own. It's all internal. Now we've got a term rider associated with this as well. So what's happening here, cash kind of stays the same and then starts to go down until year 8, where we are able to cut the term rider, and we made another move with the policy 2, which reduced the death benefit, and then the cash begins to increase. However, with that said, look at this. Between years 11 and 12, when the policy finally breaks even, that means you paid in $300,000 as a 60-year-old male, and 12 years later, you got your money back by making a one-time payment. Non-MEC traditional life insurance policy. Not attractive, right? I wouldn't do it. I wouldn't do it at 30, let alone 60. Then we've got the examples with spreading it out over 3 years. So annual out of pocket is $100,000. Much stronger break-even point. Look at this. Year 4. Very strong from a performance standpoint. And this also begins to address the question we hear all the time for someone in their 60s. You know, we'll hear, I've got to be too old for life insurance, right? If we're price quoting, the cost will be higher. If you are optimizing it for cash value, the death benefit will be lower for an older individual than it is for a younger individual. If that makes sense. We've got more content we can send you on that if you like. But point being, spreading it out over 3 years, way stronger break-even point. If you want to compare the year 12 mark, look at this difference. Over 100K. Same insurance company, same out-of-pocket, just spread out over 3 years, and you've produced over 100 grand more than the one-time lump sum. It's interesting, isn't it? The reason why is this. So this base premium here, you covered it for 3 full years. Meaning, those are years it did not have to pay itself. Those are 2 years less of drag that you had over here. Now beginning year 4, there's drag on the policy, but you've got enough money into the policy where it's compounding. There's enough acceleration, there's enough movement forward to help make up for the drag. So now I'm starting to see, okay, spreading it out over 3 years, got the policy up and running, so now it can easily support that premium and still appreciate. And then we make the exact same move here after year 7, cut the death benefit, term reduction, reduce paid up. This is optional, we don't have to do it, but it does accelerate the cash value growth. And then we've got spreading it out over 5 years. So 60 for 5. You'll notice the ratios remain consistent in all of these. But what happens now, break even, same point in year 4, same point in time. What's different though, much stronger in cash value. Beginning year 7 actually. We've only got 2 years of drag, we can call it, where that premium's due and we're not paying it, but it is a much lower premium. So the policy only has to internally pay a 6K premium as opposed to a $10,000 or a $30,000 premium. So the interest earned is greatly exceeding the premium due here. So this is why, if we look here, Not a huge difference, but you do see there's about 2K here. As we look over time, about 4K. Again, not huge. You'll find that the sweet spot for someone age 60 is typically going to be between 4 and 5 years. But right here, not a big difference even with the 3Pay. But it's good to see this kind of stuff, presenting options and such, where we see everything up front, so there's no chance of buyer's remorse or anything like that. You know, a lot of times when showing these options, someone might say, okay, you know, I've got the lump sum today. I don't want to be on the hook to pay anything thereafter, but I might want to keep adding money. I want to keep that option open, Steve. I don't want to just shut it down after 3 years, which you can definitely do. So in a case with any of these, I mean, in theory, you could make the 300, you can even make the one-time 300 payment, but let's say we do this one, 100 for 3, and then you stated, you know what, I want to keep funding. I had a couple good years. I can't pay in 100 anymore, but maybe I'm paying in 25K a year. And I pay that for 5 or 7 years. Maybe I go all the way down. I want to keep on pumping cash into it. You can do that kind of stuff. Now, depending on how much the upfront design is important, point being, you can design it to be flexible. So in any event, to kind of get back on track, when it comes to funding a policy with a lump sum, it is often more efficient for the consumer to spread it out. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.